Should scalpers always use tight stop losses for risk? Imagine being in a fast-paced game where every second counts and a small mistake can wipe out your entire day's profit. That's what scalping feels like in the trading world. It's all about quick trades, small gains, and rapid decisions. Now, one common question is whether scalpers should always use tight stop losses to control their risk. Let's break down what that really means and when it makes sense. Scalping involves making dozens or even hundreds of trades within minutes or seconds. Since each trade aims for tiny price moves, even a small adverse move can wipe out your profit or cause a loss. That's why many traders relying on tight stop-loss orders. These are preset points where you automatically exit a trade if the price moves against you. They act like a safety net, preventing small losses from snowballing into big ones. Risk management is key in scalping because of the speed and volume of trades. Without strict controls, losses can pile up quickly, especially if the market suddenly becomes volatile. Tight stop losses help keep losses small and manageable. They also remove emotional decision-making, which is crucial when trades happen so fast. When emotions run high, traders might hold onto losing trades longer or exit too early, both of which can hurt performance. Position sizing is another reason tight stops are popular. Scalpers usually trade small amounts of money relative to their total capital. This way, even if a stop loss is hit, the damage is limited. For example, if you risk only 1% of your account on each trade, a tight stop loss ensures no single loss can wipe out your account. This approach allows traders to survive losing streaks and stay in the game longer. Market conditions also influence how tight your stop loss should be. In highly liquid stocks or options with narrow bid-ask spreads, you can set stops closer to the entry price. But if the market is more volatile or less liquid, slightly wider stops might prevent being stopped out by normal price fluctuations. Using technical tools like short-term moving averages, support and resistance levels, or momentum indicators can help determine where to place stops. These levels reflected meaningful price points rather than random noise. However, there are downsides to very tight stop losses. If they are too close, normal market noise can trigger frequent stopouts, which means you exit trades that might have turned profitable if given more room. This is called being stopped out by 1,000 cuts. It's a balancing act, tight enough to limit losses but not so tight that normal price swings cause unnecessary exits. In stock trading, tight stops help manage quick intraday moves. In options trading, they are even more important because of leverage and time decay. Options can move sharply in a short time, so a tight stop can prevent large losses. But traders must also consider bid-ask spreads and liquidity to set realistic stop levels. To sum up, scalpers should generally use tight stop losses as part of their risk control. But they need to adjust the tightness based on market volatility, the trading instrument, and their strategy. Properly set, tight stops help protect capital, keep losses small, and support disciplined trading. It's all about finding that sweet spot where risk is managed without getting stopped out prematurely.